Hi everyone, and welcome to our latest Plimsoll webinar. Today's session is Acquisition Pitfalls and how to avoid them. So it's great to have so many of you here with us today, from investment teams to corporate strategists to business owners exploring growth through acquisition. So welcome all. Now, whether this is your first step into M&A or your 50th, today's session will give you a much sharper insight, clearer focus, and the tools to make your next moves with confidence. For any of you that are new to Plimsoll, we've been analysing company performance and uncovering acquisition opportunities since 1987. So sadly, that's almost 4 decades of helping leaders identify the right targets at the right time and ultimately for the right price. So over those years, we've evolved from traditional industry analysts into a world-leading intelligence platform, combining advanced data science with expert insight. And today, Plimsoll's powered decisions for over 35,000 clients in well over 100 companies, from blue chip corporations to private equity firms and all the way down to your more ambitious SMEs. Now, Plimsoll's trusted because we don't just crunch numbers, we interpret them. We find meaning, pattern and possibility in raw data. So when it comes to acquisitions, that clarity can make the difference between a brilliant deal and an expensive mistake. Now, after thousands of conversations with CEOs, CFOs, corporate financiers, entrepreneurs, we've noticed the same traps appear over and over and over again. The pitfalls that turn what should be a strategic win into long-term regret, essentially. So today we're going to talk about the 6 most common acquisition mistakes, the pitfalls, and more importantly, how to avoid them in 2025's fast-moving economy. Mistake 1, having too narrow a search. So let's start with the most fundamental one, really, which is focusing your search too narrowly. It's natural, really. You begin with what's familiar. Maybe you're only looking in your own geography or within your own sector or at companies that are officially for sale. But that limited approach often blinds you to the best opportunities. The truth is, the most valuable acquisition targets are rarely those that are waving a for sale sign. They're quietly performing, maybe undervalued, maybe going through a transition, and that's where opportunity really lies. In 2025, the M&A world is being significantly reshaped by technology, decarbonisation and digital disruption. Entire industries are reconfiguring themselves. A couple of obvious examples: the green energy supply chain is merging and consolidating at a record pace. AI integration has become a key driver of strategic acquisitions in manufacturing and logistics and most other parts of the economy. In professional services, we're seeing mid-tier firms buy niche tech players just to stay competitive. So if you're looking where everyone else is looking, you're already behind. At Plimsoll, we help you see beyond the obvious. Our data tools scan tens, thousands, millions even of companies to identify those that match your exact criteria, not just in size and location, but in performance trends, market stability, and above all, strategic fit. Think of it this way. A narrow search gives you a list of names. A Plimsoll powered search gives you a map of opportunity, highlighting where value, timing, and alignment intersect. And that's the difference between chasing deals and creating them. Mistake 2, paying too much. The second mistake is as old as acquisitions themselves, overpaying. In M&A, excitement can often cloud judgment. Bidding wars ignite, expectations spiral, and suddenly you're paying a premium that your balance sheet might take years to justify. We've all seen cautionary tales from, WeWork's implosion to Peloton's post-pandemic correction. Valuations swing wildly when they're built on narrative rather than fundamentals. So how do you avoid falling into that trap? Well, first of all, you need an independent, evidence-based valuation on any target, not sentiment and certainly not hype. Plimsoll's valuation models use multi-factor analysis that considers profitability, assets, liabilities, market trends and future growth potential. Putting that into plain English will tell you not just what a company's worth today, what it's likely to be worth tomorrow. For example, we've recently helped a UK packaging manufacturer identify a target that on paper it seemed overpriced. Our analysis, however, showed that its long-term profitability trajectory justified the investment. Within 18 months, the acquisition had paid for itself through new market share and efficiency gains. Conversely, we've also saved clients millions by revealing when an apparently cheap deal was masking deeper structural issues. That happens often. In a market where private equity activity remains intense and capital costs have risen, a disciplined valuation is everything. Now with us, with Plimsoll, you go into those negotiations knowing your ceiling price and also knowing why. And that clarity, it turns negotiation from guesswork into strategy. Mistake 3, bad timing. Let's talk about timing, arguably the hardest variable in any acquisition. Most companies buy too late. They wait until a business is officially for sale or until the competition's already started circling. At that point, prices rise, pressure builds, competition gets involved, and your negotiating power just evaporates. In 2025, timing is even trickier. Economic recovery is uneven across sectors. AI and automation are disrupting entire industries. An early stage distress, especially among companies that are expanded rapidly post-pandemic, is creating both risks and opportunities. Now, to succeed, you need foresight. It's as simple as that. The ability to see which companies are trending downwards before the decline is public and which are quietly strengthening before anyone else notices. That's where Plimsoll's long-term trend analysis shines, really. Our platform tracks 5 years of performance data for every company in a given market. That lets you identify early indicators, slowing turnover, tightening margins, rising debt, that can signal opportunity before others even realise there's a story unfolding. Take, for example, the renewable energy sector. Many smaller firms scaled aggressively between 2021 and 24. Some are now over-leveraged but have excellent underlying technology. Now, those are prime candidates for a smart, well-timed acquisition. And Plimsoll's data highlights them before the rest of the market even catches on. So, good timing isn't luck, it's visibility. And with Plimsoll, you can see the future forming before the headlines break. Mistake 4, taking the acquired company in the wrong direction. Once you've completed your acquisition, well, that's when the real work starts, integration. And that's where many great deals or potentially great deals stumble. We've often seen new owners move too quickly. They've slashed costs, they're imposing change before understanding the acquired company's unique value drivers. In doing so, they're accidentally dismantling the very qualities that made it worth buying in the first place. In 2025, post-acquisition integration is a discipline in itself. And the most successful acquirers use data-led insight to decide what to keep, what to merge, and what to evolve. One of our clients in the professional services sector, for example, learned this the hard way. They acquired a smaller competitor, immediately centralised operations, assuming that efficiencies would follow. Instead, they lost a lot of key staff and a lot of key clients within months. And when they came to us for analysis, Plimsoll's data revealed that the acquired firm's localised model had actually been its secret strength. So we helped them rebuild around that insight, and within a year, profitability was higher than before the merger. So the moral is, don't just buy a company. Understand it deeply before changing it, ideally before even buying it. Plimsoll's 5-year trend analysis, alongside our peer benchmarking, gives you that deep understanding. And you can see where a business has been strong, where it's vulnerable, how to align it with your own operations without losing what made that acquisition target great in the first place. So integration guided by insight doesn't just protect your investment, it often multiplies it. Mistake 5, relying on word of mouth or of advisor recommendations. Now, this one might surprise you. because it's still incredibly common. We meet executives all the time who make acquisitions based on a tip, a contact, or the recommendation of an advisor. While those sources can be useful, they can also be dangerously narrow. The problem isn't necessarily bad advice, it's incomplete advice. In 2025, the M&A world is just too complex, too data-rich, too competitive to rely on anecdote. Deals that used to take 6 months to source now appear and disappear in days and weeks. You know, a name mentioned on a golf course might be long gone by the time you get there, or the price has soared to something that just doesn't fit you anymore. Instead, you need evidence. Plimsoll gives the power to compare every potential target against hundreds of peers instantly. You see their financial strength, their profitability ranking, their risk level, and future growth prospects. You can spot whether that tip is genuinely a hidden gem or a high-risk detour. And because our data covers every major market, you can also find your own hidden gems without waiting for anyone to whisper them in your ear. You know, one of our private equity clients recently told us, we don't wait for deals to find us anymore, we use Plimsoll to find them first. And that's exactly the shift that we want for you, to move your acquisition searching from reactive to proactive. Mistake 6, not having your own house in order. And finally, the one most people only realise too late. It's easy to get caught up in the excitement of acquisition, but if your own organisation isn't financially stable, operationally sound and strategically clear, even the perfect target can become a burden. We've seen it happen far too many times over the years. Companies pursue growth through acquisition when what they really need first is consolidation or restructuring. Think about the post-pandemic retail and hospitality sectors. Some groups expanded aggressively in 2022, chasing market share before their core business had really recovered. 2 years later, many are now divesting those same acquisitions because they're under financial pressure. The lesson of all that? Well, you can't really build stability on instability. That's why before any acquisition journey, Plimsoll recommends a business health check. Our platform gives an instant objective assessment of your own company's financial position compared to its key competitors in its key markets. You'll see your strengths, your weaknesses, and your capacity for making an acquisition before you commit capital spend or management bandwidth to pursuing deals. Because the best acquisitions aren't just about finding the right target, they're about being the right acquirer. So there you have it, the 6 most common acquisition mistakes and how to avoid them. So if there's one key takeaway from today, it's this. Successful M&A isn't just about luck or connections. It's about clarity of timing, clarity of valuation, clarity of direction, and clarity of purpose. And that's exactly what Plimsoll delivers to our clients. For nearly 40 years, we've combined world-class data science with human insight to help our clients buy smarter, grow faster, and outperform their peers. Our intelligence powers the decisions of leading corporate strategists, private equity firms, and advisors around the world. And now we want to help you all do the same. So before you all log off today, what we'd like to do is just give you a flavour of how we could help you. So if you give us your criteria, the sort of companies that you're looking for, we'll give you a free count of how many companies we can find. It's free, it's no obligation. We'll just give you a full breakdown of the company. You get a free report giving you the company numbers that match that criteria. All you need to do is just drop us an email at enquiries@plimsoll.co.uk or call one of our acquisitions team on 01642 626 400. Remember, in 2025's hyper-competitive environment, opportunity moves fast. The companies that win are those who act with data, not instinct. At Plimsoll, we don't just help you find targets, we'll help you find your advantage. Right, thank you so much for joining us today. As I say, anybody that drops us an email with their criteria, we will give you a free count report of the number of targets we could find for you, and that's free with no obligation at all. You will receive a summary white paper as well, just summarising the 6 key acquisition mistakes that we've covered today. And that will be in your inbox as soon as this session is finished. So until next time, stay data driven, stay strategic, and let Plimsoll help you lead the market, not follow it.